What if I told you there's a way to get investment returns that beat most financial professionals, not by being smarter or faster, but by simply refusing to play their game? Consider this undeniable fact. In 2024 alone, 65% of large-cap active funds in the US failed to match the S&P 500. This isn't a one-off thing. It's a consistent and repeated pattern in the markets. Even worse, it was higher than the 60% from the year before. A worrying trend for anyone trying to beat the market. So why pay high fees for worse results? Active management promises smarter thinking, special insider knowledge, and picking the next big winner. But the facts tell a more serious story. For most, it's a game where the odds are stacked against you. It's not about a lack of talent. The problem is built into the system. The market is a zero-sum game before you even count costs. For every smart buyer, there's a seller who made a mistake. Together, before costs, you match the market. With costs, the scales tip against you. The solution: buy and hold the entire market. Forget the needle, buy the haystack. That's the core of passive investing. To understand the passive approach, appreciate the engine of wealth, the US market. The past doesn't guarantee, but it guides. Over the very long term, the S&P 500 averaged about 9.5% per year, with dividends reinvested. Reinvesting dividends is super important. It shows the combined growth of business leaders. It's capitalism itself powering portfolios for generations. Heads up, nominal doesn't equal real. Inflation eats away at your money. Look at real returns. Over 20 years adjusted for inflation, about 8.4% per year. That's a real increase in your buying power. Owning companies keeps and grows wealth faster than the cost of living. The S&P 500 gives you a diverse and clear stake. You're not betting on just one company, or just one industry, or the judgment of just one manager. You get to use the whole market. The index changes. It removes failures and adds leaders. It stays current with what's happening without you lifting a finger. This system is the standard, what active funds must beat. It's not about 1 year of 12%, but about doing it consistently, after costs, to justify fees and risk. The market sets a high bar. Owning it gives you that right. If it's a zero-sum game before costs, then to get the most, you need to pay the least. Simple math is the weak point of active investing and the biggest strength of index investing. 0.64% for active versus 0.05% for an index 2024. That's a 0.59 percentage point difference. Less than 1% sounds small, but it's 12 times more expensive. It's not a one-time thing. It's a yearly toll no matter what. A guaranteed headwind just to match the market. Example, $100,000, 30 years, 9.5% gross return. Alex, index fund, 0.05%. Ben, active fund, 0.64%. Alex's net, 9.45%, becomes about $1,458,000. Ben's net, 8.86%, becomes about $1,254,000. Over $200,000 less, about 14% of wealth lost. And that's just for the clear fee. Trading more often adds costs, brokerage fees and bid-ask spreads, and it can make your tax bill worse. The hurdle becomes, for most, too high to clear. Beyond the math, human nature. Fear and greed drive bad decisions at the wrong times. The active structure makes this bias worse. The passive approach forces discipline. During exciting times, fear of missing out and overconfidence lead people to chase expensive assets right before they drop. During panics, people sell at the bottom and miss the recovery. Following trends often leads to buying high and selling low. Efficient markets reflect information almost instantly. Consistently beating that collective intelligence after costs is incredibly hard. SPIVA compares thousands of active funds to their indexes. The clear conclusion, year after year, most don't beat the market. The longer the time frame, the worse the underperformance. Over 15 years, about 90% of active managers fall short of their benchmark. By chance, 9 out of 10 times you would have done better with a cheap index fund. This pattern repeats across different types of assets and regions. Even big institutional accounts, over 80% underperform over 10 years after fees. You're looking at funds that exist today, not all the funds that ever existed. Many, especially the worst ones, disappear. This removes the failures from the record and paints a rosier picture. SPIVA says about 64% of domestic funds close or merge over 20 years. Merging hides bad performance and makes comparisons confusing. An index doesn't disappear. Its record is continuous and clear. Simplicity, low costs, and discipline beat complexity. The strategy? Own the market at a low cost and stick with it. SPIVA confirms, trying to beat it is a losing game for most. The passive approach solves costs and human biases. Few will beat the market. Finding them ahead of time is almost impossible. For the average person, it's better to buy the haystack and capture the whole market, minus a tiny cost. Before choosing complexity and high costs, ask yourself, discipline to capture the market or to feed your ego?